The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box. I'm Steve Sedgwick with Karen Cho, and these are your headlines. President Trump announces plans to impose reciprocal tariffs on all US trading partners, with sweeping and incredibly complex implications for global exporters.
I have decided, for purposes of fairness, that I will charge a reciprocal tariff. In other words, they charge us a tax or tariff, and we charge them the exact same tax or tariff. Very simple.
Well, yields drop, the dollar eases, but Wall Street shrugs it off again. Investors shrugging off Mr. Trump's latest tariff threat, whilst wholesale inflation shows signs of slowing.
HSBC reportedly lines up a fresh round of global job cuts, with Europe's largest lender eyeing $1.5 billion in annual cost savings to be announced in the earnings next week. Spanish lender Santander denies reporting of talks on a potential sale of its UK retail business to Natwest. We'll discuss M&A and earnings with Natwest CFO Katie Murray at 7 GMT.
And strong Chinese demand drives a top and bottom line beat for Moncler, with the Italian luxury brand also turning attention to its American business. Morning, Karen.
Good morning and happy Valentine's Day.
Well, happy Valentine's Day, yes. You are resplendent in red, of course. Mine is a little bit more, dare I say...
Slightly more subtle.
Yes, there are actually red hearts on my side.
I was going to say, they are hearts, aren't they?
Yes, it's a French tyre from a well-known manufacturer. I don't think they like to call themselves manufacturers.
May or may not be reporting annual results today.
I don't know about that. But what I do know is that at 1 Eastern time, onwards, we were all waiting with bated breath, because I think we're getting to the real deal now on the Trump tariffs. He kept us waiting quite a while. And to be honest, everybody, I think we are all going to be keeping waiting as well. It is stunningly complex. Howard Lutnick, of course, he's the one who's going to be looking into the detail, working out where these tariffs go, which industries, which countries. Anyone who tells you without doubt that it's going to be X, Y or Z from these tariffs is wrong, because we just don't know, and it is stunningly complex.
But the market has moved. The market moved in a fashion yesterday, suggesting a little bit of relief that it wasn't a blanket-style tariff announcement. That again, we could be talking about nuances here, negotiating tactics. And I wonder whether that is the right approach, or whether we're looking at a very, very complex, deep due diligence that is taking place, which actually is going to deliver consequences just different to what the market is anticipating.
I don't think the market can factor in yet. And I'll be brutally honest, I think the market just wanted to go up yesterday on the equity market, and I think it went up. I think there is a glib complacency. You may well be right. I think there's a glib complacency about the ramifications of what is transpiring now, if it happens. So I'll go through some details, and then we can fill in some more with Karen and our guests in a bit. Because President Trump has announced plans to impose what he calls reciprocal tariffs. Big signature, once again. Trump said they will be set on a country-by-country basis, taking tariff and non-tariff trade barriers into consideration. The Commerce Secretary, the aforementioned nominee, by the way, he's still a nominee, Howard Lutnick, told reporters studies into tariff levels would be complete 1st of April, which may or may not be April Fool's Day. Anyway, President Trump looked to dismiss concerns that it could lead to higher inflation for Americans.
I'll tell you what will go up is jobs. The jobs will go up tremendously. We're going to have great jobs for everybody. This is something that should have been done many years ago. China did it. I mean, China did it at a level that probably nobody's ever seen before. If you manufactured a car, you couldn't send it into China. The tariff was so high. So everybody went and they built in China. It was no big secret. So we're going to see, but it's going to mean tremendous amounts of jobs. And ultimately, prices will stay the same, go down.
Well, let's just start with the headline number here. We're talking about $1 trillion trade deficit. That's what the administration is trying to tackle. And it feels as though they've deployed some forensic accounting here to go through every single line item where there is a trade and trade tariff. And I think that's where it gets messy, because some countries may simply fold and you may see a negotiation. Others you may see retaliation if we are talking about tariffs that are going to remain in place. So I think that is fascinating. The other big consequence for me has been on the WTO. Where does it leave the international rules-based system? Favoured nation is what WTO works on. If you've got agreements, free trade agreements, and then of course there's been incentives, motivation to cut free trade agreements because you get rid of some of the tariffs and some of the quotas on goods coming into your own country. So how does that upend the free trade system that has been negotiated between countries, some by blocks and some between countries? So I think that is fascinating how it leaves the WTO again on the back foot, because it's almost a country by country direct approach that you're now seeing. Of course, the United States may conduct its business like that, but where does it leave other countries, and does it leave the WTO without weapons down the track for other nations?
So, yes, and you absolutely quite correctly say, or very correctly, it is so complicated. We've got a brilliant article, by the way, which is helping decipher it. So while you're watching us and other social media, whatever you're doing at the moment, have a look at this article as well, because as Karen mentioned, it's very granular, and to be fair, we are speculating, but there are instances. For instance, it talks about the pharmaceutical industries, which included $127 billion worth of EU imports of semaglutide. So GLP-1 straight away. We're talking about weight loss drugs as well. So again, your Mercedes, your BMWs, your Volvos, your Volkswagens, also potentially, even though a lot of them have big operations in the United States. One of the biggest single importers of product into the United States is IKEA. So your flat pack, some of you love to hate it. I quite enjoy the challenge of a flat pack. But so when you're talking about semaglutide, you're talking about LVMH, you're talking about your champagne, you're talking about your flat pack furniture, and we can go on. We probably do too much sometimes, certainly I do. But there are a lot of individual nuances here, and this is what Howard Lutnick is working through.
Exactly, and I think it's going to take time. So the whole point around negotiation is whether you simply see countries say, we'll take our tariffs off, we'll all come back to a zero position here where there are no quotas, no tariffs. And does that help reset the position? Or are we still talking about a US market that doesn't have capacity in some areas where factories are not going to come back? You know, that's going to be a long-term story. So I think what are we trying to correct here is that the simplicity of just taking away extra costs for American businesses when they are importing things and there are tariffs in effect.
I mean, you're going to look at the markets now, I think. But one more comment about this from me as well. This isn't asymmetrical. This isn't just one-sided, sorry. We've talked about a lot of the negatives. Well, actually, the US has collected a lot of money in tariffs over the last few years under two different administrations, even before Trump 47 as well. And actually, we don't have skyrocketing inflation at the moment. Let me just give you an example here as well. US trade tariffs have generated $264 billion of higher customs, according to data collected from the US government from importers as of the end of last year, according to the Tax Foundation, right? $89 billion of that was collected under the Trump administration, but $175 billion was collected during the Biden's term. So there's a couple of things we can work out from that. One, it's not just the Republicans. This is not just a Trump story. This is both administrations prior to this one. And also, there is an argument that it will not lead to sky-high inflation. This is what we need to pore over in the coming days, weeks and months with our guests, because $264 billion collected in recent administrations, and quite frankly, it is hard to discern the effect on the broader CPI data. Karen, as we said, the markets seem to brush it off.
Yeah, first up reaction that we're not talking about blanket tariffs here. So the market regrouped, pushed high, and you could see it right across from the Dow, the S&P and the Nasdaq. Technology names in particular out in front. And we've been hearing a lot of chatter in recent days that there could be targeting of some of those big technology names if we are talking about blanket tariffs. That was truly just going to be a list where some countries would look at those big tech earnings and come up with some measures to target them. Don't forget the Chinese had gone down that pathway in recent times, looking at how they could go after big Silicon Valley names. So what you've got in terms of the reaction yesterday, very strong. Nvidia, one of the big moving stocks to the upside for the major boards. You saw the ARK Innovation Fund, that soared about 3.3% as you talk about some of those tech momentum names. And as you look at all sectors, it was materials out in front, up 1.7%, the laggard industrials. To Treasuries, and the yield came back. We've pulled lower off that 4.6% handle on the 10-year, currently 4.53. So telling you how the market is judging some of the risks here around inflation and what the consequences of tariffs will be. 4.29 at the short end. To the dollar trade. The reaction on foreign exchange markets, euro dollar sliding a fraction this morning, about 1/10%. So we're 104.54 morning trade. Sterling giving back territory to the dollar as well. So on those trades, greenback is still king in versus a Swissy. The exception here is the Japanese yen that's trying to claw back some territory and picking up about 1/10% plus to the greenback. To the Asian markets for the Friday session, this is how we look. It's been a stunning trading period thanks to DeepSeek and quarters of the Chinese market. And you can see again, look at Hong Kong stocks. This is in some ways just re-weighting where there's been a very low rating on China and Chinese tech. And don't forget, over the years, Chinese tech has been in the sights of many regulators. It has not been an easy trade. What you're seeing on the DeepSeek news, it is really lifting these trades. Alibaba, as it's been talking about a partnership with Apple on AI, that stock up 2.5%. JD soaring almost 4%. Tencent, Xiaomi up 4.7%. So right across the tech basket. DeepSeek still having an impact. The opening calls to round it out for you. Europe is looking a little bit mixed this morning. Now, the FTSE yesterday, it was at a fresh all-time intraday high, but it was down by the finish yesterday versus other major markets. Again, huge momentum on the DAX, up more than 2%. It is looking to give back some of that territory this morning out of the gates.
We need to focus on the data as well. Why do I focus on US data so much? Because it often, of course, is a precursor to what the Fed says, which is a precursor to what happens on rates, which is a precursor to the Treasury markets, and we all price off the US. It is a fact. We could spend more time talking about the European bond market, but we price very much of what's going on stateside. We may not like it in this side of Atlantic, but it happens. US producer prices came in hotter than expected in January, rising 0.4% on the month after an upwardly revised 0.5% in December. However, apparently within the data, there are signs within the report that inflation is easing, with healthcare prices, which account for such an emotive issue stateside, let's be brutally honest about it, but also almost 1/5 of the weighting actually declined 0.6%. Meanwhile, the weekly jobless claims, they came in a little lower than expected at 213,000. Continuing claims fell more than 30,000 to 1.85 million. Speaking to this very channel, the former Fed president and University of Pennsylvania adjunct professor of finance, Loretta Mester, said she does not see rate cuts on the horizon.
We haven't seen the progress that we'd like to see on inflation. It doesn't mean that inflation won't start to move down later this year. No, you can't say that yet. We saw higher inflation numbers at the beginning of last year as well, and then inflation began moving back down. But I would say at this point, there's no compelling reason to cut rates, and holding this seems to be the best play here.
Let's get to Carl Schamotta, who is Chief Market Strategist at Corpay. Carl, thank you very much for joining us today. We are seeing a Fed trying to calibrate what the impact of Trump policies will be on the inflation environment. And the big news yesterday was that we're talking about reciprocal tariffs now, country by country, line item by line item. But the market was not exactly spooked by that. So just talk us through what we're seeing in terms of that reaction.
Yeah, so it's a fascinating thing here. I mean, the market did exhibit a very counterintuitive reaction. I think if you were to think about it from a headline perspective, it certainly seems alarming that that this Trump administration intends to hit virtually every trading partner with some form of tariff. But when you think about how markets were positioned going in, they were worried that we were going to see sort of an immediate implementation of potentially a universal tariff against all trading partners. That did not happen. It sounds like we're looking at a very delayed implementation and one that would have a lot of carve-outs within it. So, you know, that's sort of giving markets room for optimism here. But the other factor I think that's really sort of fascinating is that within this reciprocal tariff framework that the administration is talking about, they're looking at a lot of non-tariff barriers. They're talking about things like, you know, foreign exchange intervention, you know, regulatory procedures, taxes like, you know, value-added taxes and things like that. And so all of that means that we simply cannot get a handle on how much, you know, tariffs might go up and which categories they might impact and which countries might be hit. So for the moment, markets are sitting on the sidelines and waiting to see how this plays out.
Carl, from what you say, that just equals uncertainty to me. And every time we talk about uncertainty, we know it's not good for business. Yet the market looks optimistic that everything can be negotiated away. Is that too much of a complacent view in your point that if we're talking about various different categories, sectors, industries being in a state of uncertainty, surely that's not good for profitability in business?
Absolutely. I think at the end of the day, this is going to dampen global investment levels. It's going to weigh on hiring levels and ultimately lead the global economy into a bit of a slowdown. And so, that's not a favorable picture. Perhaps it's better than what markets had feared at one point, but it is certainly not a rosy picture for earnings, for risk assets globally, and for, the actual population of the world. So I do think that, at the end of the day here, we are looking at a president who's being walked off a ledge here to some extent. It does seem as if he's come in with a lot of rhetoric and a lot of plans. And, perhaps the adults in the room are talking him away from that. And I think that's fundamentally what markets are betting on here, is that at the end of the day, what's implemented will not be as bad as what was, sort of threatened on the campaign trail and immediately after Trump's inauguration.
Said you in Toronto, Carl. I mean, of course, you've been in the eye of the storm. Carl, I hear you, but you talk about the adults in the room, the Scott Bessents of this world, the Howard Lutnicks. They're the ones who are front and centre behind this as well. These are brilliant businessmen as well. Do they know something we don't about the benefits potentially of these policies? Because they're not stupid. They're very transactional. They're very smart and they're very rich.
Yeah, but it does seem to me as if they don't support the idea of a universal tariff either. The reality is that it's very, very difficult to find an economist or anyone who's watched macro for the last couple of decades who does support tariffs on the scale that Trump has proposed. Right. I think that they are seeing this very much, as many market participants are, as some sort of negotiation tool. Now, I would very much agree with you, though, that there's a huge possibility here that we're all wrong, right? That this is not a negotiation tactic, that this is something that Trump fundamentally believes in and that he thinks he can earn revenue through. You were mentioning earlier the sort of intake that we're getting into the U.S. fiscal picture from tariffs, and it does seem as if thus far Trump has prioritized those countries with big trading relationships with the U.S. simply so that he can sort of ratchet up the amount of fiscal inflows that he's getting from tariffs. And unfortunately, the reality is that this is too small in proportion to the overall spend of the U.S. government to really make a dent. And so, at some point, something needs to break. I don't know whether it's going to be on the adults in the room side or on the Trump side. But yeah, markets are still, ahead of that pivot point fundamentally.
I wonder if, ahead of them, market's way behind what's going on. Why is the market, do you think, well, and I say the market, we talk about all kinds of asset classes here, but the equity market specifically, why does it seem so glib? I use the word complacent. I may be completely wrong. I'm happy to say that. It seems nonchalant as well, as the French might say, about this whole thing. Is the market wrong?
Perhaps it is, but again, there's this theory out there that Trump is using the S&P 500 as a guidepost, almost as a benchmark for his policies, and that if there were a sell-off, we would have a quick retraction or reversal in Trump's policies. Now, of course, the risk with all of this is that we're lulling, the reaction in markets is lulling everyone into complacency, right? It may be that equity markets are not giving Trump the signal that he needs to know that these policies are going to be so damaging. And that's something that could unfold over the next couple of weeks, right? It could happen very quickly in the sense that if at some point markets do take him seriously and literally on these tariffs, that we could have that very big reversal that we've all been fearing for the last couple of months.
Carl, indeed, very much a Teflon reaction on markets at the moment. Thank you so much for joining us. Carl Shamotta, Chief Market Strategist, Corpay. Steve.
Right. Coming up on the show, HSBC is reportedly starting a fresh round of global job cuts at its investment banks. We'll have the details next. Plus, ARM is reportedly on track to release its very own chip, with Meta set to be one of its first customers. And we're going to be speaking to Katie Murray. She's the CFO of Natwest as we break the British bank's full year results for 2024. That conversation, 5 minutes past 7 GMT.
Moncler has reported better than expected sales in the fourth quarter, boosted by double-digit growth in China. The high-end clothing maker posted a forecast-beating 7% jump in full-year consolidated revenue to 3.1 billion euros. Let's get to Charlotte for more on this. Charlotte, something looks like it's going right, and I do wonder whether it's the direct-to-consumer approach where they're keeping a very close watch on their brand and how it lands in the marketplace, because let's face it, this could easily fall out of fashion. It is in a particular segment of the market. As consumer trends change, it could be easily left on the shelf, but it's just simply not.
It's a very specific segment. At the same time, you could say they have a very unique positioning. So when they do things well, of course, it can work for them. And again, the luxury sportswear area is one that's been growing very rapidly recently. But there were all eyes on this quarter because Q3 was actually did worse than expected. So there were some concerns of whether things were turning for that brand in particular, given the very high exposure they have to China. They made about 50% of their revenue in that region. So there was all eyes on this, but the results were much better than expected there. So it looks like, there is a slowdown in China, but not for all the luxury brands. And here again, this is the message that we keep getting, that some brands are doing better than others, and that consumers maybe are picking the brand that they go to. It'll be interesting to watch Hermès, that is published a little bit later this morning, to see whether we see the same trend. But here again, as you were saying, they saw a return of double-digit growth in China. They don't break down entirely the numbers per region, so they just give us some aspects. What's interesting is that they are very little exposed to the US, and that is one that we know has some of the green shoots when it comes to luxury, according to the previous luxury results we've seen this quarter, and they're just starting to expand in that region. They bought the lease for a flagship store on Fifth Avenue that they will open only at the beginning of 2026, and there's a lot of analysts see a huge area of potential growth for Moncler in that region as well.
I think Karen's going to come in for a sensible question, but I'll just get this out there because I am the cheapskate of CNBC. I've just had a look at their US site and the Mayef hooded short down jacket, which I actually really like. How much do you reckon? Oh, you're going to know.
For a hoodie?
For a man, a gentleman.
A jacket?
Yes, it's a short down jacket. Mayef hooded. It's their top. $2,400. It's above my pay grade. Anyway, your sensible question for Charlotte.
It's not cheap. But something that jumped out to me, and we've seen, I think, from other consumer brands in the past couple of weeks, has been the increased marketing spend to recapture the spending dollar, those acquisition costs. I thought it was fascinating to see that go up, and I wonder whether they're going to have to keep chasing the customer with these great acquisition costs to keep them on board.
And they have their different collections. They have the core collection, they have the Grenoble, which is the performance, the actual skiing one, and they have the Moncler Genius. When they do these shows, they do these collaborations with designers. They did a big one in China just last year, and that's one that's more of a fashion project. That gives them that exposure. It's part of that marketing, gives them positioning them as a fashion brand as well, not just a technical kind of brand. Even though, again, the outdoor and sportswear segment of luxury is one that is growing very rapidly. And here again, analysts say they might move Moncler, the CEO might move Moncler, not just skiing kind of thing, but just a broader sportswear, whether it's hiking, biking. There are other areas that can be growing.
It's the collabs, isn't it? Skims with North Face sold out almost instantly. And one of the viewers sent it to me, and I went and had a look, and it was like every item almost sold. You've got Fusap, you've got Perfect Moment. It's very fast growing.
Footwear as well, and that's why LVMH wanted do you remember, they bought a 10% stake in the group in September last year, because they want a little bit of slice of that pie as well.
Super. Thank you very much indeed for that, Charlotte. Right, talking of luxury, Porsche is preparing to cut, an additional 1,900 jobs over the next 4 years. The German automaker grappling with weak demand for EVs. The cuts will reduce its workforce at its main sites in Germany by 15%. This comes on the back of the story we talked about yesterday, that luxury EVs in China are so good now, the domestic brands, that Porsche, and I have driven a Taycan, it's a phenomenal vehicle, but it's expensive. Anyway, this comes as the car maker started cutting roles last year, not renewing 1,500 fixed-term contracts, with another 500 now coming to an end.
We're hearing a lot about job cuts, and elsewhere too, HSBC is reportedly set to launch a new round of job cuts at its investment bank. That's according to Bloomberg, which says the cuts will start in Asia but be global. It comes as the Financial Times says HSBC will report $1.5 billion of annual cost savings next week as part of the CEO Georges Eldery's radical overhaul.
Right, let us move on, because the speculation won't go away. Anna Botín has said to us, she said on a panel of mine, she said to other journalists, they're not selling UK assets at the moment, but has reportedly discussed a potential sale of its UK retail business with Natwest. Now, this is the FT plugging away at this story, which cites people familiar with the matter as saying early stage talks took place last year and both parties remain interested. The timescale's absolutely pivotal. Did they have a brief conversation? Was it a real conversation? Is it ongoing? It appears not at the moment. Santander has insisted its UK business is not for sale and remains a core part of its globally diversified business model after reports last month that it was exploring a potential UK exit.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.